In today's video, we're going to be pitting cash value life insurance against a taxable investment. Hey folks, I'm best-selling author of The Power of Zero, David McKnight. Financial gurus like Dave Ramsey and Susie Orman preach a lot of good things. For example, they freely acknowledge that tax rates down the road are likely to be dramatically higher than they are today. For that reason, they openly tout the benefits of true tax-free investments like Roth IRAs, Roth 401ks, and Roth conversions. However, once these accounts are maxed out, they recommend that you contribute any surplus retirement savings to a taxable investment account. Even though you're paying taxes and management fees, your net growth will still far outstrip any other alternatives, including cash value life insurance, or so the thinking goes. Well, how do we make sense of this recommendation? If their adherents were to implement this one-size-fits-all financial advice, how would things turn out? To explore the implications of this recommendation, I took a 40-year-old in a 30% marginal tax bracket, that's 24% federal and 6% state, who has an extra $20,000 per year he can contribute to retirement savings. For the purposes of our comparison, I assumed that this taxable investment account had an expense ratio of 1%. I also assumed a 6.6% rate of return. What I found was that in the 25th year, when the investor reaches age 65, he will have accumulated $841,378. Not bad, right? Well, let's compare it against our cash value life insurance alternative. If we grew that money at the exact same rate inside a cash value life insurance policy known as Index Universal Life, the investor will have accumulated $1,344,713 by age 65. In other words, by simply diverting that $20,000 of surplus savings to cash value life insurance in contravention of Susie Orman and Dave Ramsey's recommendation, the investor will have accumulated $503,335 more money over that same time period. Furthermore, that money can be taken out as a tax-free stream of income over the balance of the investor's retirement. Not to mention that the cash value life insurance at that point has a total death benefit of $1,613,656 that can be accessed in advance of death for the purpose of paying for long-term care. And all of this is without taking any more risk than what you're accustomed to taking in your savings account. That's a pretty safe and productive way to grow at least a portion of your assets. Now, the skeptic might look at this comparison and say, well, sure, if you limit my taxable investment to only 6.6% growth, of course the life insurance is going to win. But if I let it rip in the stock market, I can easily outpace that rate of return. Well, that of course begs the question, what pre-tax rate of return would the taxable investment need to net 6.6% growth after tax? To figure that out, we simply divide 6.6% by 1 minus the marginal tax rate, which in this case is 30%. So we're essentially dividing 6.6 by 0.70. And when we do that, we get 9.42%. In other words, you'd have to get 9.42% growth in your taxable investment to be able to net 6.6% after tax. Furthermore, how much risk would you have to take in your taxable investment to be able to achieve that 9.42% pre-tax rate of return? The answer is a substantial amount. Now, am I here to say that cash value life insurance should replace your stock market portfolio? Absolutely not. There's a huge place for stock market investing in a balanced, comprehensive approach to tax-free retirement. What I am saying, however, is that we need to be sober and clear-eyed about the rate of return necessary in your taxable investment to be able to eclipse the rate of return you'd experience in your cash value life insurance. In summary, once you fully fund your Roth IRA and Roth 401k, you have a decision to make. Do you invest any surplus funds into a stock market portfolio within your taxable bucket, or do you contribute those dollars to cash value life insurance? Based on the comparison we made today, it's clear that the life insurance gives you a greater return with much less risk than the taxable alternative. Furthermore, it gives you the luxury of taking tax-free distributions over the balance of your retirement. I don't think there's any real question as to which alternative will push you further ahead over time. Cash value life insurance in the form of Indexed Universal Life. If you need any help with the concepts we discussed in today's video, head on over to davemcknight.com. I'm happy to lend a hand. And if you have any comments or questions, drop them into the comments section below. I respond to every single one of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.